Have you ever looked at your finances and thought, how can I make my money do more? More than just grow. How can I use it for real impact? Impact for causes I care about, and maybe for my own financial future, too. A lot of people think charitable giving is just, well, writing a check. But what if I told you it could be one of the smartest moves you make, strategic even, for your long-term planning, your family's legacy?
Sure.
We're going to unpack how strategic giving isn't just generosity. It's a powerful financial tool. We'll explore some pretty sophisticated techniques, actually, ways to support causes you love while also, optimizing your tax situation, building
Okay.
something lasting.
Exactly. And what's really fascinating is realizing that philanthropy, it isn't some separate thing over here. It's actually deeply connected with your overall financial plan, your estate planning objectives. And a key piece really is understanding how the federal tax code incentivizes giving. It offers some pretty significant benefits that, well, you might not even be aware of.
Okay, let's unpack that from the ground up. When we talk about these foundational tax benefits, where do we even start? Is it really just about getting a deduction?
That's a great place to start, yeah. And often it does begin with deductions. So for those of you who itemize, list out specific expenses instead of taking the standard deduction relating to contributions to qualified 501c organizations are really key. These are basically IRS-recognized nonprofits. Your donations to them, typically tax deductible. And the concrete benefits, they generally fall into, let's say, three main buckets. Income tax deductions, helping with estate taxes, and avoiding capital gains tax. Now, there are limits. Always limits, right? For income tax deductions, they're based on your adjusted gross income, your AGI. Cash contributions, usually deductible up to 60% of your AGI. Donations of appreciated property, like stocks you've held, that's typically limited to 30%. But here's the interesting part, the flexibility. If you give more than those limits in 1 year, you can carry forward the excess deduction for up to 5 years. And this leads to something called a bunching strategy, especially useful for, say, high-income donors.
If you know you'll have a high-income year or just want to get over that standard deduction hump, you can basically make several years' worth of donations all at once, bunching them together. This can really maximize your itemized deductions and unlock some significant tax savings, especially if you combine it with other deductions you have.
So, okay, donating cash is foundational, and even that has strategy around timing, like bunching. But here's where I think it gets even more impactful for a lot of people. Let's talk about donating appreciated assets, stocks you've held for years, maybe real estate. Why is giving these specific things so powerful, especially compared to just, selling them and donating the cash?
This is often a real game changer. When you donate appreciated securities, stocks, mutual funds, held over a year, you get this fantastic dual benefit. First, you completely eliminate the capital gains tax you'd owe if you sold them yourself. Gone. Second, you can still claim a charitable deduction for the full fair market value of those securities, not just what you paid for them originally. Think about it. A stock you bought for $10,000 is now worth $100,000. Sell it. You owe tax on $90,000 of gain. Donate it directly. The charity gets the full $100K. You pay zero capital gains tax on that appreciation, and you get a $100,000 charitable deduction. It effectively lets you give more to charity, sometimes significantly more, while keeping more of your wealth working for you, not going to taxes.
Wow. Okay, that's a huge nugget right there. Turning a tax bill into a bigger gift. Now, real estate, you mentioned that. It sounds more complex, but potentially very impactful too.
Absolutely. It is more complex, no doubt. Donating real estate, a whole property, maybe just a part of it, or even development rights requires careful planning. You need proper valuations, you have to consider potential environmental issues, things like that. But the payoff can be huge. It's a powerful way to unlock wealth that might be tied up, illiquid. Maybe a business owner has a property they don't use anymore, it's appreciated a lot. Donating it can bypass that capital gains tax, generate a big income tax deduction, and support a cause they care about. Sometimes you can even structure it to retain certain rights, like living in a donated home for a set time.
Okay, so we've got direct giving covered cash, appreciated stocks, even real estate. But what if you want more flexibility? Like, you want to make a big contribution now for the tax benefit, but maybe decide later exactly which charities get the money. This seems like where donor-advised funds, or DEFs, come in. They seem incredibly popular lately. How do they actually work?
They are very popular, and for good reason. Think of a DAF like your own personal charitable savings account. It's held by a sponsoring public charity. You make a contribution cash, stocks, maybe even more complex things like private company stock or increasingly cryptocurrency. And it's irrevocable, so that is key. You get an immediate tax deduction for that contribution right when you make it. And this is the strategic piece. It separates the timing of your tax deduction from your actual grant making. So you get the deduction now, maybe in a high-income year. Then, over time, you recommend grants from your DAF to the specific charities you want to support whenever you're ready. Next month, next year, even 10 years from now. And the beauty of DAFs, well, there are several layers. You get that immediate deduction. Your contribution can be invested inside the DAF, potentially growing tax-free, meaning more money for charity down the road. It lets you research charities, time your grants strategically, gives you immense control without the hassle of running your own foundation. Plus, the contribution limits are quite generous, typically 60% of AGI for FASH, 30% for appreciated property. You can even make gifts anonymously if you prefer. It's almost like having a mini foundation, but much simpler administratively. Just remember, the sponsoring organization has ultimate legal control, though they almost always follow donor recommendations.
That sounds incredibly flexible, really powerful for managing the timing. Okay, but what if your goal is different? Maybe you need income now, perhaps for retirement, but you also want to leave a significant gift to charity later. This brings us to something called Charitable Remainder Trust, or CRTs. How do these structures manage that balance?
CRTs are really smart tools for exactly that situation. Their main job is to provide an income stream, either to you, the donor, or maybe other people you name, for a set period or for life. After that income period ends, whatever's left in the trust, the remainder, goes to the charity or charities you designated. There are basically two main types. A CRU, Charitable Remainder Unit Trust, pays out a percentage of the trust assets each year. So if the assets grow, your income potentially grows too. Then there's a CRU, Charitable Remainder Annuity Trust, that pays a fixed dollar amount each year, more predictable income. But here's the sort of non-obvious win with the CRT. It's not just about the giving. It's a fantastic way to handle a highly appreciated asset that's maybe not producing much income. Imagine you have a lot of company stock, it's gone way up, but you can't sell it without a huge tax hit. You could put it into a CRT. The trust can then sell the stock, often without paying immediate capital gains tax. It reinvests the proceeds, diversify, creating an income stream for you. And you get benefits up front too.
An immediate charitable income tax deduction when you set up the trust, based on the estimated value going to charity later. Plus, the assets are moved out of your taxable estate. It's a way to convert that appreciated asset into income, diversify, plan for charity, and potentially reduce estate taxes all at once. The deduction calculation uses IRS tables, looking at the present value of what charity is expected to receive.
That is really sophisticated, managing assets, income, and charitable goals. Okay, but what if you flip that idea around? What if you want income to go to charity first and then have the assets come back to your family later? That sounds like charitable lead trusts or CLTs. How do these work? You mentioned they're powerful for estate planning.
Exactly. CLTs basically reverse the CRT structure. With a CLT, the trust makes payments to a charity for a set number of years, say 10 or 20 years. That's the lead interest. After that period is over, whatever assets remain in the trust pass to non-charitable beneficiaries, usually family members like kids or grandkids. They're particularly effective as wealth transfer tools, especially for minimizing gift and estate taxes. Here's the strategic angle. When you set up the trust and designate your family as the remainder beneficiaries, the value of that future gift for tax purposes is reduced. It's discounted by the present value of all those payments going to charity first. And in times of low interest rates, that discount can be really significant. It means you can potentially transfer substantial wealth to the next generation with a much lower gift tax cost, sometimes even zero, all while making significant contributions to charity during the trust term. CLTs work best if you fund them with assets you expect will appreciate faster than the IRS's assumed rate, the Section 7520 rate. If your assets outperform that rate, that extra growth passes to your heirs, essentially tax-free from a gift estate perspective.
It's a very powerful technique in the right circumstances.
Wow, okay. So we've gone from like simple checks all the way to these complex trusts, DAFs, CRTs, CLTs. But for people with really significant philanthropic goals, maybe wanting maximum control, multi-generational impact, there's a private foundation, right? What makes a private foundation different? Who are they really best suited for?
Right, private foundations are sort of the ultimate vehicle for large-scale, long-term philanthropy. They offer the most control and flexibility. You can set very specific grant-making rules. You can involve family members directly in the giving decisions, really shape a lasting family legacy around philanthropy. And a key aspect is they can potentially exist in perpetuity, continuing your charitable mission for generations. Now, with that control comes more responsibility. Private foundations have more administrative requirements, ongoing expenses, and stricter regulations compared to, say, a DAF. Contributions still get you immediate tax deductions, generally up to 30% of AGI for appreciated property, 50% for cash. But they have a mandatory annual distribution requirement. Usually at least 5% of their assets must be paid out for charitable purposes. They're also subject to certain excise taxes and rules about their operations. So they're really best for donors making substantial long-term commitments who want that deep level of engagement and control, potentially operating worldwide.
That's a fantastic overview of the different tools. So let's pivot slightly. What does this all mean for the when and how? How does this fit into your bigger financial picture? Let's talk timing. Does it actually matter when you make these gifts during the year?
Oh, absolutely. Timing can be quite strategic. Lots of people focus on year-end giving, maybe rushing to get deductions in before December 31st. And that's fine. It works. But there's another way to think about it. Making contributions earlier in the year, especially into vehicles like DAFs where the money can be invested. Well, that gives the charitable dollars more time to potentially grow tax-free before you grant them out, maximizes the pot for future giving. It really depends on your cash flow, your income expectations for the year, and your overall tax planning.
And speaking of timing and the bigger picture, there's a really neat strategy, almost a loophole, but perfectly legal for older donors involving their retirement accounts, isn't there?
Yes. This is such a crucial point for donors over age 70 and a half. It's called a Qualified Charitable Distribution, or QCD. If you're at the age where you have to take required minimum distributions, RMDs, from your traditional IRA, the amount that the IRS says you must withdraw each year, you can actually direct up to $105,000 per year. That's the limit for 2024. It's indexed for inflation directly from your IRA to a qualified public charity. And here's the magic. The distribution counts towards satisfying your RMD for the year, but it is not included in your taxable income. For many people, this is way more tax efficient than taking the RMD as income, paying tax on it, and then making a separate cash donation where the deduction might be limited or not useful if they don't itemize. It's a direct tax-free transfer to charity.
That is incredibly powerful, especially for retirees trying to manage their taxable income. Okay, broadening out again. How do all these charitable strategies really mesh with someone's bigger estate planning goals?
They integrate really well, actually. Often they become a central part of achieving wealth transfer objectives. For instance, simply putting charitable bequests in your will or trust. That can generate significant estate tax deductions, reducing the overall tax burden on your estate. And the lifetime giving strategies we've discussed using DAFs, CRTs, CLTs, donating appreciated assets, they work by removing assets, especially appreciating assets, from your taxable estate during your lifetime. This can dramatically reduce potential estate taxes down the road, meaning more of your wealth goes where you intend to your heirs and the causes you support, rather than to taxes. And we shouldn't forget about businesses either. There are specific opportunities for business charitable giving. This could be straightforward corporate contributions from a C Corp, or maybe donating inventory that's slow-moving or obsolete, getting a deduction for that. Conservation easements on land owned by a business is another area. And for owners of pass-through businesses, like S-corps or partnerships, charitable contributions made by the business itself can flow through to the owner's personal tax returns. It's another way to integrate giving with business operations and values.
Okay, this has been incredibly comprehensive. So let's try to distill this. For you, the listener, considering all these powerful options, what are the absolute must-do best practices? And maybe what are the common traps to avoid?
Okay, best practices. Number one, absolutely crucial. Have clear philanthropic objectives. Really know why you're giving and what you want to accomplish. That guides everything else. Second, this isn't a set it and forget it thing. Regularly review your strategies with your advisor's financial planner, accountant, attorney. Your circumstances change, laws change, your charitable interests might evolve. Third, get professional guidance. These tools, especially the trusts and foundations, are complex. You need experts to structure them correctly and make sure you're complying with all the rules. As for pitfalls, a big one is not doing enough research on the charities themselves. Make sure your money is going to effective organizations aligned with your goals. Another is not fully grasping the commitment involved. Many of these strategies, like contributions to DAFs or trusts, are irrevocable. You can't change your mind later. And maybe the biggest pitfall is not aligning your giving with your overall financial plan. Doing charitable planning in a silo without considering your retirement needs, cash flow, estate plan, that can lead to missed opportunities or even unintended negative consequences.
That makes perfect sense. And beyond the planning, the paperwork matters too, right? Documentation, compliance, especially for those non-cash gifts.
Oh, absolutely critical. The IRS has specific rules. For non-cash contributions over certain amounts, you generally need qualified appraisals. There are specific tax forms, like Form 8283, that need to be filed correctly with your tax return. Good record keeping is essential to make sure you actually get the tax benefits you're entitled to. It's all about dotting the I's and crossing the T's to ensure your generosity is properly recognized and rewarded by the tax system.
So, what does this all mean for you, the listener? I hope this deep dive shows that charitable giving is so much more than just, writing that check. It's really a powerful suite of tools. Tools to achieve your philanthropic dreams, yes, but also to optimize your taxes, support your overall financial health, plan your estate effectively. From strategic cash giving and bunching to donating stock, using dApps, setting up sophisticated trusts, even private foundations, there's a whole spectrum of options out there. Something likely fits your situation and your aspirations.
And when these strategies are really understood and implemented correctly, you get these fantastic win-win outcomes. Vital support flows to worthy causes doing important work in the world. And at the same time, you, the donor, benefit financially through tax savings and smarter asset management, allowing you to make an even bigger, more lasting impact.
Absolutely. And maybe one final thought to leave you with. Beyond all the numbers, the tax benefits, the financial strategy, how might understanding these tools empower you to think differently about your own legacy, about the kind of ongoing impact you want to have, maybe in ways you hadn't even considered before? Now that you know the breadth of options available, maybe take a moment and reflect on what causes truly resonate with you, what kind of long-term impact feels meaningful, and how might one of these strategies we've discussed help you turn that vision into a reality?